how I trade my model, and a lot of other ICT traders trade theirs as well. This is one of the fundamental core concepts. So this is day 5, and we're going to be going over fair value gaps. What are fair value gaps? Fair value gaps are liquidity voids in the market, which are formed by a 3-candle pattern. It can be bearish, there can be bearish gaps, there can be bullish gaps, there can be overlapping gaps, which is known as a BPR. But more or less, it's an area in price where we have moved very quickly from point A to point B, and then we leave behind these fair value gaps on the way up or down. So what do they look like? So I drew out a little diagram right here. It's a 3-candle pattern, and it looks just like this. So what we'll do is we'll be looking in the market, and we will see, okay, we have one big candle here. I'm actually going to remove this just to kind of help for a moment. But we see a 3-candle pattern. We got the first candle, the second candle, the third candle. As you can see, we went up, just pretty much straight up. We didn't have a candle down. We didn't whatever. So this range in here is left unbalanced. How do we identify what range needs to be balanced? So these fair value gaps are the things that we're looking for, are from the wicks of the first to the third candle. I know I started from the third candle, but technically, whatever, it's the same thing. So from the wick of the third to the first, or the first to the third candle, as long as they're not overlapping in the body. Now, if it was like, if I can click it, if it was like this, for example, and instead this wick came all the way down here. Oh, so it'll let me draw. If this wick came all the way down to here, and then this wick came up to here, they're overlapping now. So there's no fair value gap. This range has been balanced. Now, if there isn't this here, it doesn't matter how small the gap is at all. If there's a gap and it's the size of even 25 cents, it's still a gap, and price can still use it as an area to retrace from. It doesn't matter whether or not the gap is huge or the gap is small. It doesn't matter. So when we're looking for these gaps, we're just looking for this 3-candle pattern, and then what we'll do is we'll look at the third candle and we'll mark out the wick, and we'll look at the first candle and we'll mark out the wick as well, the high of the wick. So for bullish gaps, it will be the bottom wick of the third candle and the top wick of the first candle. For bearish gaps, it will be the bottom wick of the first candle and the top wick of the third candle. But the second candle, we don't care about these wicks. These wicks can go wherever they want. We care about the body. Now, if the body of this candle was like this right here, and instead, the body was up here, and we were like this, there's no gap, there's no inefficiency, because if we look at the wick of the first candle, right here, if we're looking for bullish gaps, if we're looking for the top wick of the first candle and the bottom wick of the third candle, there is no area in here where price hasn't hit. It is a relatively simple concept. Some people do overcomplicate it. I don't want you to get over, whatever about it. It's not a really tough concept. It's as simple as it kind of seems. But yes, these fair value gaps are literally everywhere. Price uses them all the time to push off of them. Right here, there's a gap right here. Price comes up, 3-candle pattern. The top wick of the first candle here, the bottom wick of the third candle here creates this rectangle, this box that we know is a fair value gap. And price will use these areas, and we'll revisit these areas like we did with this candle right here to then fill orders and push price higher. It's a retracement. If we think about it in terms of lines, where's the tool? Right here. Cool, right? What we're basically looking for, just generically, is this area where there's, imagine a candle right here, imagine a candle right here, imagine the bottom wick being here, and the top wick of this candle being right here. This would leave a range. So in this diagram that we made below, I'm going to show what it would kind of look like when we fill one of these. So let me go and put this back down to where it was, just so we have it all set up. Cool. Great. Great, cool. Actually, no. There. Sorry, technical difficulties. Cool. Just trying to make this exact so it's easy for you guys to see and understand. So if we're looking right here, we're going to look for the high of the first, the bottom of the third, and then what are we looking to happen after that, right? So what we would look for is for price to do some form of this. It's not going to be identical every single time at all, and they come in all shapes and sizes. But what you'd be looking for more or less would be something. I'm going to make this red. Cool. You'd be looking for something like this, for us price to wick back into it, or a body can go into it, as long as this candle close isn't below this body, because that's another concept altogether. But if we come into here and we balance price, we take this fair value, this liquidity void, and we tag into it to use to fill orders. What we're looking for is us to tag into it, and then for us to then, I'm going to make it green so it's easier. Can't talk. Something like this. It's not going to look the most beautiful in the world. I'm not an artist, but you get the point. So what we're looking for is basically for price to make this fair value gap right here, right? This void in price where the wicks don't overlap with the second body, and then we're looking for price to rebalance these ranges and then to push off of it. So we're going to go over a bunch of examples. This isn't a very hard concept. People overcomplicate it a lot, but it's a lot simpler than a lot of people make it. So let's get into it. Let's just go find a whole bunch of examples because they're all over the place. I'm going to start off on the hourly time frame. Right here, I'm just going to move all this stuff over to the side. So right here, 3-candle pattern. By the way, I forgot to mention, this candle can be a bearish candle, this candle can be a bullish candle, and this candle can be a bearish candle if it wanted. The point is that the first wick and the third wick are not overlapping the second body. So right here, we look at this and we go, okay, there's a fair value gap right here. I'm going to make that, keeps auto setting it. You know, we came up, price kept pushing higher. What do? We retraced down to the fair value gap. We use the fair value gap to push orders, and I'm sorry, to fill orders, to push price higher. I'm sure we do it again right here. Yep, right here, 5 minute. And there can be multiple of them. Like in this case, right, we have one gap here, first candle and the third candle. The wicks don't overlap. It's small, but they don't overlap. We filled price into it and the second gap below it and pushed higher. Now, there isn't a specific gap. When there's a whole bunch of gaps like this, we could go down all the way to right here and then still pull back up. We can go down to this one in here and push back up. We can go back to right here and push up. We can even hit this first one and just keep pushing up. It doesn't always matter. The point is that we use it to gauge. Typically, what you want to do is find just the singular gap, the highest time frame gap of the current trading leg. But I'm not gonna fill your brain too much with too much information yet. We're gonna keep getting into that and just keep building off of the steps that we're learning. So right here, we came in, we rebalanced the range, we pushed price higher. Then we came back down, we broke structure to the downside, we filled deeper into these gaps down here to fill more orders. Then price pushed higher. We can go on the 4-hour. Right here, made a fair value gap right here. Price came up, revisited this range, then it went all the way back up again. Price, same thing right here. There's a fair value gap between these two candles, right? So how do we mark it out? We're going to look, okay, cool, right here, right here. There's the gap. Now we're looking for price. Oh, price is up here in real time. You know, maybe this candle's up here. Well, we have a 4-hour gap below. We could come down and rebalance this range, you know, start building that kind of narrative. We could come down and tag this fair value gap. We came down, we tagged it, we pushed off of it, and then we made new highs. On the way down, did the same kind of deal. Made this bearish gap right here. So we went all the way down here. Price came all the way back up. Price refilled this area. And then what do we do? Like, did we fully push down and make full new lows? No, but we reacted off it very strongly. Price pushed into this little gap right here, filled orders, and then this daily candle just collapsed. Sorry, it's hard to see a little bit just because of the, I don't know why the volume's showing up on the bottom. See if I can fix that really quickly. Maybe. I don't think it's gonna do it. I don't know. I'm gonna go down to lower time frames because it's gonna be a pain to do it like that. But anyways, yeah, so they happen with bullish gaps, bearish gaps. They're all over the place. Right here, made a gap, price came down, filled orders, pushed price higher, right? Right here, another gap, price comes down, pushes price higher off of it. Another gap right here, price comes down, pushes price higher off of it, right? Another gap right here, price comes down, pushes price off of it. We can keep going up. And they're all over the place. Like these happen on a very regular basis. And like, in my opinion, honestly, like gaps are what kind of really move the market. Well, obviously, in reality, you know, buyers and sellers and institutions and whatnot move the market. But like, we revisit these ranges all of the time. And does every single one work all the time? No. But when they don't work, it's a different concept, which is called an inversion. I'm going to get way more in depth in it. But like, for me, what I use because inversions are the model that I use to enter. So if we come up and we retest this gap and I'm like, okay, I need confirmation that we're going to reject off this level, I'll look for this gap right here and say, okay, in theory, we should probably, if we're going to go down, disrespect these gaps. We do right here. My entry would literally be right here, and I would have caught X, Y, and Z all the way down to wherever I was targeting. But yeah, I mean, it's really pretty easy to spot. So what we're looking for, you know, like in areas like this, you could even go like that, and that's, well, don't do that yet. I just want to keep it simple and make sure you guys are kind of understanding what a fair value gap is. But yeah, so it's just an area in price where price has ran through the area, comes back to rebalance the area that really didn't have much time to fill many orders. And then we use it to fill more orders and then push price higher off of it. We do this all the time. Like, you can see it literally everywhere. Another gap right here. What do? Price goes up, comes down, fills it, orders. Like, literally everywhere. Go to the 30-minute. Right here, we come down, price makes a gap right here, comes up, fills orders, pushes off of it. Right, so, you know, the first candle, the low, third candle, the high, make sure it doesn't overlap in the second candle's body. And yeah, price will fill orders and push off of it, and it'll do the same thing right here. Another gap is created, filled orders, pushed off of it. It happens on every single time frame, all over the place. I can go on the daily, the weekly, the monthly. All of it has gaps and forms gaps. But yeah, just, it's not a really difficult concept to understand. It's just when you're looking for where price will go, right? You can find the draw on liquidity. You can find the trend, right? Like, let's say, I don't know, let's say there's a random high over here somewhere. Or let's just say this was a random high, right? Where price came up. you kind of establish, okay, hey, maybe we have a previous day high up here. It looks like we're bullish. We're reaching for it. There's kind of your narrative. I'm looking for an entry to that drawn liquidity. I know price reacts off of fair value gaps. Oop, there's a fair value gap right there. We just had a little liquidity sweep of this low down here. We have an S&T. Well, I'm not going to. I'm just going to keep it as simple as possible. A liquidity sweep, which we learned about before. I'm going to go a little bit more in depth with that on another video as well. But yeah, we have a liquidity sweep down here. We have these lows established. Liquidity comes down, gets swept, so it stops all those people that were long. The banks use it to fill their orders to push price higher. Price expands rapidly, so we leave behind a fair value gap. Then price comes and revisits that range. You say, hey, I want us to go higher. I think we're going to bounce off of this gap because we're going to go trends. Think about trends. Here, sorry, I'm just really trying to make sure this is getting understood. Like right here, we go up. Then we come rebalance this range. It's the same as if we were to go up here and rebalance this range right here. Just imagine a fair value gap right there. You could possibly people enter on the fair value gaps. That is an entry model that a lot of people use and you can use and be profitable from. But yeah, you establish the drawn liquidity. You have your narrative. Maybe you have a liquidity sweep. You have a fair value gap. You're waiting for the fair value gap to get retested on the retracement down. Then you push off of it, and then you're in the play targeting whatever your draw is, and then you would exit at your draw, and bang, you just made 20 bucks or whatever. That's not financial advice, by the way, but you get the point. It's not a very hard concept to understand. Don't overcomplicate it. Look for 3 candles, and mark out the high and the low of the wick. Find that little box. Wait for price to go down, retest it, and then watch it go off of it. I kind of want to give you. I haven't been giving like homework or anything, but what I would recommend is going through and finding like 50 examples of this because they're literally everywhere, all over the place. Here's one right here. There's another 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 one right here. Like. Another one right here. Price fills orders, pushes lower. Does it fully go down? No, it still reacted off and filled orders. Find these areas and kind of understand what they look like. We're going to go over it a lot more in depth in the Discord when we're live next week. So if you're not in there, I definitely check it out. But that's the basis of a fair value gap. It's just a area in price where orders have been filled usually pretty rapidly, and we leave behind a liquidity void where price will go to rebalance price, fill more orders, and push price higher, put in the most simple way possible. So that's fair value gaps. We're going to go over some more later, but I'll see y'all in the next one.